Did China's gold market just send a terrifying warning to the world? Is the foundation of the world's largest physical gold market cracking? In mid-September 2025, whispers from the digital sphere swelled into a roar of panic. Social media platforms were ablaze with claims that China's colossal wholesale gold market, the Xuebai district in Shenzhen, a global nerve center for the precious metal, was not just faltering but had suffered a catastrophic collapse. These initial reports painted a picture of absolute chaos. Dozens of dealers vanishing overnight, storefronts shuttered, and a wave of fear gripping the thousands of businesses that call this 2-square-kilometer jewelry hub home. Such news is startling, not merely for its dramatic tone, but because Xuebai is the barometer for China's entire gold industry, a sector deeply intertwined with the nation's economic health and its citizens' financial security. The immediate problem, however, lies in the stark chasm between panicked online narratives and the more measured, albeit still concerning, reality on the ground. While the word collapse captured global attention, it quickly became apparent that this was a significant exaggeration, a piece of sensationalism likely engineered for digital engagement. Official Chinese media outlets and industry associations were quick to counter the narrative, stating the rumors of widespread bankruptcy were largely inaccurate, and that law enforcement had intervened where specific businesses faced issues. This leaves us with a complex puzzle, a market clearly in distress but not in the throes of a complete systemic failure. The real story isn't one of a sudden crash, but of a market buckling under the immense pressure of deep-seated economic anxieties and shifting financial currents. To truly understand the tremors felt in Shenzhen, we must look beyond the immediate headlines to the broader economic landscape of China in 2025. For years, Chinese households sought refuge from a volatile domestic stock market and a deepening property crisis by pouring their savings into gold. Gold bars, coins, and jewelry became the default safe haven asset, a tangible store of value in uncertain times. This persistent demand created a robust internal market. However, 2025 marked a significant turning point. The confluence of record-high global gold prices and newfound optimism in domestic equities began to fundamentally alter this dynamic, creating the perfect conditions for the disruption witnessed in the Xuebai market. The catalyst for the September panic can be traced to a series of social media posts that began circulating around the 13th of the month. These posts identified specific gold dealers who had allegedly fled, leaving downstream merchants and suppliers in the lurch with losses potentially in the millions of yuan. This was not merely a rumor but a tangible event, with images of sealed storefronts lending credence to the claims. The panic was amplified by the conflation of this event with long-standing concerns about fraud within the Chinese gold market, including whispers of counterfeit bars filled with tungsten or copper being sold, a problem that has plagued the industry for years and eroded trust. The incident in Xuebai, therefore, was not the cause of the market's problems, but the dramatic symptom of an illness that had been festering for months. It was the moment that underlying weaknesses burst into public view. The fleeing of a few dealers, while significant, was the spark that ignited a tinderbox of pre-existing market stress. This stress was born from a potent cocktail of record-high gold prices that choked off consumer demand and a resurgent stock market that suddenly offered a more attractive alternative for investors' capital, forcing a painful reevaluation of gold's role in the average portfolio. The true tipping point for China's private gold market occurred not in the chaotic days of mid-September, but a month earlier, in August 2025. Data reveals this was the moment the market's internal dynamics visibly inverted. The CSI 300 stock index, a benchmark for China's largest companies, surged by an astonishing 10%, fueled by aggressive government policy support and renewed investor confidence. This rally acted like a powerful siren's call to retail investors, who began pulling capital out of gold and pouring it back into equities, seeking the rapid profits that a booming stock market can provide. The evidence of this capital rotation is undeniable and stark. In August alone, Chinese gold-backed exchange-traded funds, ETFs, witnessed massive outflows, with investors pulling the equivalent of $834 million from the funds. This retreat from paper gold was mirrored in the physical market. Wholesale gold demand, best measured by withdrawals from the Shanghai Gold Exchange, plummeted in August to its weakest level for that month since 2010. The market had reached a critical juncture where the allure of stocks decisively overshadowed the safety of gold for the average investor. This dramatic shift in investor sentiment created what economists refer to as price fatigue. For much of the preceding 2 years, Chinese consumers had been reliable buyers, but the relentless climb of gold prices throughout 2025 began to deter new purchases and even encouraged profit-taking. Consumers and investors alike grew weary of the high entry point, making them highly receptive to alternative investment opportunities. The rallying stock market provided that alternative at precisely the right moment, triggering a significant rebalancing of portfolios away from the precious metal. The immediate impact of this capital flight from gold was felt most acutely by the wholesalers and dealers in hubs like Shuobai. They were caught in a painful squeeze. On one side, the cost of acquiring new inventory remained historically high due to the global spot price. On the other, domestic demand from both retail consumers and jewelry manufacturers had evaporated, leaving them with stock they couldn't move. This created a liquidity crisis for many, forcing them to offer gold at significant discounts, reportedly as much as 3% below the spot price, in a desperate attempt to generate cash flow. The situation in Shenzhen is a textbook example of market bifurcation, revealing two parallel but opposing stories within China's gold ecosystem. While the private and wholesale markets were experiencing a sharp downturn driven by weak demand and competition from equities, the official sector, represented by the People's Bank of China (PBOC), was telling a completely different story. The central bank remained a steadfast and aggressive buyer of gold, continuing a relentless accumulation of reserves that has been a defining feature of the global market. As of August 2025, the People's Bank of China had increased its official gold reserves for 10 consecutive months. This consistent buying is part of a long-term strategic imperative to diversify its foreign exchange holdings away from the US dollar and bolster the nation's financial sovereignty. This state-sponsored demand provides a significant floor for the global gold price, yet it does little to alleviate the immediate pressures on domestic wholesalers who rely on private consumption, not central bank purchases, for their business. The government was buying, but the people were selling or staying away. The aftermath of the Shuobai disruption is a market grappling with a crisis of confidence. For the dealers who remain, the business environment is fraught with peril. The discounts they must offer to attract any buyers are eroding already thin profit margins, pushing some to the brink of insolvency. The news of fleeing dealers and persistent fraud allegations has also made downstream buyers, such as jewelry manufacturers and retailers, increasingly cautious, further slowing the velocity of transactions and compounding the liquidity crunch throughout the supply chain. Furthermore, the events have cast a long shadow over the perception of gold as an infallible safe haven asset among the Chinese public. The experience of 2025 has been a harsh lesson in market dynamics. Even an asset with deep cultural and financial significance is subject to the fundamental principles of supply, demand, and opportunity cost. When a viable, high-performing alternative like a rallying stock market emerges, investor loyalty to gold can prove surprisingly fickle, especially when its price is perceived as being prohibitively high. An intriguing secondary effect of this gold market turmoil could be a significant pivot towards silver. As gold prices remain elevated and out of reach for many average consumers, silver presents a much more affordable entry point into precious metals investment. Historically, in high-demand markets like China and India, there is a strong cultural affinity for both metals. It is highly plausible that the price fatigue plaguing the gold market could translate into a surge of new demand for silver, as consumers seek to protect their wealth with a tangible asset without paying the steep premium for gold. This potential shift is a critical trend for global commodity markets to monitor. Both China and India have demonstrated a voracious appetite for silver in the past, and a renewed wave of consumer and industrial demand from these demographic giants could provide a substantial tailwind for silver prices globally. The struggles of the Chinese wholesale gold market might, paradoxically, be the catalyst that awakens a sleeping giant in the silver market, creating new opportunities for investors and altering the traditional gold-silver price ratio. The long-term takeaway from the Shenzhen episode is that the health of China's wholesale gold market is inextricably linked to the broader health of its domestic economy and the sentiment of its retail investors. The collapse narrative was inaccurate, but the underlying volatility it exposed is very real. It serves as a powerful reminder that no market, not even one as culturally entrenched as gold in China, is immune to fundamental economic pressures. The incident is less an indictment of gold itself and more a reflection of the complex challenges facing the Chinese economy. Moreover, the events highlight a crucial tension between the objectives of the Chinese state and the behaviors of its citizens. The government's strategic accumulation of gold for de-dollarization purposes is a geopolitical maneuver that operates on a different plane from the retail investor's quest for accessible returns. While the PBOC's buying provides a structural support for the market, the Xuebai crisis demonstrates that this official demand cannot fully insulate the domestic commercial market from the consequences of weak consumer confidence and shifting investment preferences. Ultimately, the lesson learned is one of nuance. The Chinese gold market did not collapse, but it did reveal significant fractures. It showed that price matters, that competition from other asset classes is a potent force, and that deep-seated cultural affinity for gold does not translate into infinite demand at any price. The story of what happened in Xuebai in September 2025 is a crucial case study in the modern complexities of a globally significant market, at the crossroads of ancient traditions and fast-moving modern finance. Deepening our analysis of the market structure, the Xuebai district represents more than just a trading hub. It is a sprawling ecosystem. Controlling over 70% of the nation's jewelry processing industry, it houses thousands of businesses, from high-tech refiners to small, family-run workshops. This concentration, while efficient, also creates systemic risk. When a handful of significant dealers face a liquidity crisis and abruptly cease operations, the shockwaves are felt instantly across the entire network, disrupting supply chains for raw materials and finished goods alike, which explains the speed at which panic spread. The allegations of fraud, while perhaps not directly linked to every dealer who fled, play a crucial role in the psychological state of the market. China has a history of high-profile counterfeit gold scandals, such as the 2020 Kingold jewelry case, where gilded copper bars were used as collateral for billions in loans. These precedents create an environment of latent distrust. Therefore, when dealers suddenly disappear, the market's immediate assumption leans toward illicit activity and fraud, further eroding confidence and prompting other participants to defensively pull back their own capital and credit lines. It is also important to contextualize the government's response. The swift downplaying of the collapse narrative by state-affiliated media is standard procedure in China's managed information environment. While this may be seen as an attempt to prevent widespread financial panic, it can also obscure the true extent of the problem, making it difficult for outside observers and even domestic participants to accurately assess risk. The official statements confirming that law enforcement was involved with businesses facing issues is a tacit admission of serious problems, even as the more alarming social media claims were dismissed as exaggerated. The role of the Shanghai Gold Exchange, SGE, as the primary hub for physical withdrawals provides the most reliable data on the market's health. The consistent year-over-year decline in withdrawals throughout 2025 painted a clear picture of weakening demand long before the events in Xuebai. This data serves as a powerful counter-narrative to the spot price of gold, illustrating that a high price does not always equate to a healthy, high-volume market. For the physical dealers on the ground, transaction volume is paramount, and by this metric, the market was in a recession. Let's reconsider the investor rotation into equities. This was not just a speculative frenzy, but a calculated response to clear policy signals from Beijing. The Chinese government, concerned about the slowing economy, has actively worked to bolster its stock market through liquidity injections and supportive rhetoric. Retail investors, who constitute a massive force in China's markets, interpreted these signals as a green light to re-enter equities. This state-guided shift in capital flow is a unique feature of the Chinese financial system and directly contributed to the hollowing out of demand for gold. The phenomenon of domestic gold prices trading at a discount to international benchmarks is another critical indicator of the market's internal weakness. In a healthy, high-demand market like China has traditionally been, domestic prices typically carry a premium. The emergence of a persistent discount throughout the latter half of 2025 was a flashing red light, signaling an oversupply relative to domestic demand. Strict capital controls that prevent gold from easily being exported mean this excess supply gets trapped onshore, forcing sellers to lower their prices to find local buyers. The struggles of the jewelry sector are a significant, yet often overlooked, part of this story. While investment demand for bars and coins is highly sensitive to price and market sentiment, jewelry demand is also tied to broader consumer confidence and economic prosperity. With China's economy facing headwinds, discretionary spending on luxury items like gold jewelry has naturally declined. This has put immense pressure on manufacturers and retailers, who in turn have reduced their wholesale orders from suppliers in places like Shuibai, creating yet another layer of demand destruction. We must also acknowledge the resilience of the market. While the events were disruptive, the Shuibai market did not cease to function. The majority of its thousands of businesses continued to operate. This suggests that the crisis, while severe for those directly impacted, was contained to a specific segment of dealers who were likely over-leveraged or unable to adapt to the rapidly changing market conditions. The system bent under pressure, but it did not break, which is a testament to the depth and scale of the industry. Looking forward, the key variable to watch will be the performance of the Chinese stock market. If the equity rally continues, the pressure on the domestic gold market is likely to persist. However, if the stock market begins to falter or if broader economic anxieties intensify, we could see a rapid rotation of capital back into the perceived safety of gold. Chinese investors have shown a tendency to move as a herd, and their collective sentiment can shift dramatically and quickly, meaning the conditions that led to the September downturn could reverse just as fast. The central bank's actions will also remain a pivotal, albeit separate, storyline. The PBOC's gold accumulation is driven by long-term geopolitical and macroeconomic strategy, not short-term market fluctuations. Therefore, we can expect their buying to continue regardless of the volatility in the private wholesale market. This creates a fascinating and complex dynamic where the official and private sectors of the world's largest gold market can, for extended periods, move in completely opposite directions, each responding to a different set of incentives and pressures. The question of silver's future role becomes even more compelling in this context. A sustained period of high gold prices could permanently alter consumer habits, leading a new generation of buyers to embrace silver as their primary precious metal investment. This would not be a temporary substitution, but a structural shift in the composition of the Asian precious metals market. If Chinese and Indian consumers begin to allocate even a small fraction of the capital they traditionally put into gold towards silver, the global supply-demand balance for silver could be fundamentally redrawn. In conclusion, the near-collapse narrative surrounding China's Shuibai gold market was a dramatic oversimplification of a much more intricate economic story. The market experienced a severe disruption, born from a perfect storm of record prices, weak consumer demand, and a powerful investor rotation into a government-backed equity rally. It was a crisis of liquidity and confidence, not a systemic collapse. The event serves as a crucial reminder that underneath the global price of gold lies a complex web of local market dynamics, where the decisions of millions of individual investors and the policies of a powerful state converge. The aftermath presents a redefined landscape for China's gold market. It is now a field where only the most well-capitalized and adaptable dealers can thrive, operating in an environment of heightened scrutiny and diminished trust. The days of guaranteed, ever-rising demand have been replaced by a more volatile reality, where gold must actively compete for capital against other asset classes. This new paradigm forces a reevaluation of risk for everyone involved, from the smallest jeweler in Shenzhen to the global institutions that depend on China as the marginal buyer. The final lesson is that the relationship between the Chinese people and their gold is evolving. While the cultural significance remains, the investment calculus is becoming increasingly sophisticated. The events of 2025 have demonstrated that pragmatism can outweigh tradition when market conditions shift. The future of this vital market will depend not just on the global price of gold, but on the delicate balance between government policy, economic stability, and the ever-shifting sentiments of hundreds of millions of savvy domestic investors.